welcome back to Investing Talk Podcast.
Today, we're looking at NVX.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We've pulled together, sources from their financials, technical charts, market buzz, the whole picture, really. And our goal today, I think, is to really unpack this core tension. NVX is making a big shift. They're moving from being, an R&D-focused company to actually starting commercial operations. And it's in a super strategic sector.
Yeah, that pivot is, it's everything right now, isn't it? NVX is right at this major inflection point. Like you said, for years, they were mostly about the promise, the tech development. Now, they're actually stepping into the commercial arena.
Yeah.
Early days, but still, critical battery materials.
Exactly. And the market saw it. It reacted immediately. The really big catalyst, the tangible one, was back in October 2025. That's when they successfully delivered their first commercial synthetic graphite sample. And look, this wasn't just, shipping a box. This was proof. It validated years of R&D spending.
And the stock price just told the story, plain and simple. That news triggered a huge rally. 39%, right? But maybe explain that a bit more. Why such a massive jump for just one sample? Seems like a lot.
Well, because it basically confirmed their tech works at scale, or at least that it can work at scale. Their synthetic graphite is high-performance stuff, vital for lithium-ion batteries. This delivery showed it could meet the tough quality and manufacturing standards needed commercially. For companies in advanced materials, validation, that's the toughest, most expensive step. Clearing that, it pretty much validated the whole business model,
Okay, yeah, that makes sense. And then there's the strategic angle. Where they sit in the market. They're looking like an early leader, maybe even the leader in synthetic graphite, but specifically for North America. And it's not just about EV demand, which is, obviously huge globally. This ties into geopolitics, too.
Definitely. It's all about supply chain reshoring. Friendshoring is the term people use. Governments, especially here in North America, are pushing hard, with real incentives for domestic production of battery parts. They want to cut down reliance on, overseas supply chains, often centered in Asia. So NVX being early here, that gives them a real leg up, potentially backed by policy, to win those big long-term contracts.
So, okay, the start is compelling. The catalyst landed. Geopolitical winds are at their back. Massive tailwinds. But let's connect this exciting narrative to the fundamentals. The actual numbers, that's where you hit that classic tension, right? The scaling growth company challenge.
Yeah.
It costs money.
Oh, yeah, the tension is really clear. On one side, analysts, super bullish. We looked at 5 analysts covering the stock. 4 out of 5 rated a buy, a strong buy, actually. They're clearly looking past the immediate financial picture.
They must be focused way out on the long range.
Mm-hmm.
Their confidence probably comes from these pretty big models forecasting huge growth in revenue and earnings down the line, especially kicking in hard around 2026, right? As that big facility ramps up. That's the promise.
That's the promise. But the current reality, it needs let's say, a sober look at the balance sheet. For the last period, revenue was still pretty small, $8.05 million. Let's be clear. This is a company deep in scale-up mode, not profit-making mode yet.
And the metrics really show that. Pre-profit status confirmed. You see negative margins across the board. Return on equity, for example, is minus 0.44%. They're burning cash to build these plans. That's the deal.
Which leads straight to the financial health check. There's moderate financial risk. You see that in the high leverage ratio, 1.6x. Now, for a software firm, that might look alarming, but here, it just shows how capital intensive this business is. Heavy industry. They have to use debt and equity raises to build facilities that cost hundreds of millions.
Right. That's the key context. It's the price of admission for this kind of industrial play.
Yeah.
And the negative free cash flow just underlines it. They're all about CapEx right now. So they're totally dependent on the capital they just raised and being able to tap markets again if needed. It's definitely a bit of a financial tightrope.
It is. So given that tension, huge future potential versus current cash burn, the question is, how does the market feel? Let's look at the charts. Does market confidence hold up despite the cash situation?
Well, looking at the technicals, it seems like the market is almost completely ignoring the immediate balance sheet issues. It tells you the focus is squarely on 2026 and beyond. The stock's in a clear bullish uptrend, trading well above both its 50-day and 200-day moving averages. That's solid confirmation of momentum, short and long term.
Yeah, the price move after that October news was really something. It shot up from around $1.53 to a high of $3.35. Lately, it's been hovering around $3.02. So for you, if you're watching this company, knowing the key levels is really important for managing risk.
Definitely. If the market gets choppy or people start taking profits, that key support to watch is $2.49. That price really needs to hold to keep this bullish structure intact.
And then on the upside, that recent peak, $3.35, that's your near-term resistance. If it breaks convincingly above that, closes above it, that signals the market might be ready for another leg up.
And importantly, the momentum indicators, things like RSI and MACD, they look positive. They show investors are buying, accumulating the stock, but it doesn't look drastically overbought right now. It kind of suggests there's more room to run, assuming the story keeps delivering.
Okay, so let's look ahead. The next, say, 3 to 6 months. What are the specific things that could make Novo Nordisk move again?
Right, the near-term catalysts. First up, the earnings report. Late November, maybe December 2025. That's crucial. Investors are going to be combing through every detail, looking for real signs of revenue, picking up from those first graphite shipments. And any change in guidance from management, up or down, that could be a huge catalyst.
We also need to watch that balance sheet update in December. We understand there's a specific payment due from an initial contract around early December. Seeing that cash actually hit the books, that would be a tangible sign, a financial signal that they're turning operations into, well, cash, even if it's small to start.
And then the big one, of course. Any news about new commercial deals? If they announce a new supply contract, especially with a big North American EV maker or a major battery company, that stock is likely going to move, probably push right through that $3.35 resistance.
Okay, so those are the things we know are coming. But let's talk about the buzz, the speculation. With a company like this tied so closely to government policy and supply chains, there's always chatter, right?
Ah, yes, the unconfirmed chatter. You gotta be careful here. Separate hype from credible whispers.
Yeah.
But some of this buzz is pretty significant if true. There's a lot of talk, on forums and industry circles about potential U.S. Department of Energy support, DOE grants, or maybe big loans.
DOE backing would be absolutely massive. Game-changing, really. Getting that kind of capital, often on good terms, plus the government's stamp of approval. It would immediately reduce that financial risk we talked about. It validates them not just commercially, but strategically for the country.
Exactly. And the other major rumor floating around is about potential multi-year supply deals. Whispers that agreements with big North American battery players are getting close. No, got to stress again, this is speculation, unconfirmed. But if those deals get announced, wow, that's instant, massive upside. That's the key to hitting those 2026 revenue targets.
And you see how this short-term speculative stuff ties perfectly into the long-term picture, those big secular trends. They're pretty much unstoppable right now. Global decarbonization and, like we said, friendshoring critical materials, that provides this multi-year foundation for growth. It kind of insulates them a bit from normal economic ups and downs.
It also makes them a really attractive target, doesn't it? You could easily see M&A possibilities or strategic partnerships, bigger industrial companies, chemical firms, existing suppliers, maybe even car companies themselves. They need to secure reliable North American supply. Novo Nordisk could be it.
That's the potential upside. Huge potential. But whenever you bet on execution, you absolutely have to look hard at the risks. And for a company moving from R&D to large-scale manufacturing, the risks are, well, they're significant.
The biggest one, hands down, specific to the company, is execution risk. Plain and simple. We know the tech works, basically. That October sample proved it. The risk now is, can they actually build out this massive new graphite plant on time and on budget?
And, crucially, can they deliver consistent quality, meeting customer specs at high volume? If they're late, if costs run over even by 10%, if the product quality isn't perfect for EV batteries, that could totally mess up their funding strategy. Customers might just walk. This is the absolute make-or-break challenge for the next, say, 18 months.
And financially, yeah, the risk is still serious. Manageable, maybe, if execution is perfect. But with no profits yet and negative free cash flow, they're very vulnerable to slip-ups. They have to manage every dollar perfectly. Any unexpected problem means going back to the market for more money, probably diluting existing shareholders.
And finally, don't forget market risk. As a speculative growth stock, it's just way more exposed than a mature company. It's going to be volatile. Any big macro shock, interest rates spiking, a general move away from risk assets, even just slower EV sales growth globally, that'll hit the stock much harder than the overall market. Volatility is just part of the deal here.
Which brings us to the final summary, the investment thesis.
Okay, so pulling it all together, the risks, the potential, the tech, the market tailwinds, the overall assessment is still strongly bullish. We're landing on an 8.5 out of 10 rating.
And the thinking there is pretty straightforward. The tech is validated, the chart shows strong momentum, and those structural market tailwinds, the need for domestic battery materials, are undeniable.
So yeah, it looks attractive for certain investors, those looking for high growth, comfortable with high risk and volatility, and wanting specific exposure to this strategic battery materials theme. It's definitely not a play on current earnings. It's a bet on perfect execution leading to future profitability. So the analysis shows Novonix has clearly hit an operational milestone with that first shipment. They've made the pivot. But the real test, the true measure of success over this next year, it won't actually be about the technology itself anymore. It's going to be about the economics of their contracts and, crucially, their ability to ramp up production fast enough to grab this vital North American market share while the window is wide open. Which really leaves us with the final question for you to think about. Is this a technology story that's already being valued correctly, or is it fundamentally an execution story that hasn't even truly faced its biggest, highest stakes test yet?